You know, one of the biggest misunderstandings about the infinite banking concepts is that any whole life insurance policy will work. And that couldn't be further from the truth. There is a massive difference between a traditional off-the-shelf whole life insurance policy and a specially designed policy that will work for the infinite banking concepts. Today in this video, what I want to do is I want to show you a side-by-side comparison of a traditional whole life insurance policy that most agents would present to you and the ones we designed, which are specially designed and engineered for the infinite banking concept and to give you high early cash value immediately in the first 30 days. Now, some of the things that you're going to see is how commissions vary. There is a massive difference between how much commission is paid out on a traditional regular whole life and a specially designed whole life. We're going to cover that. We're going to cover how much more cash value you're going to have because there's an exchange, commission to the agent or cash value to you. So in today's video, I'm going to break down exactly what makes the difference and how that difference will benefit you, your family, and your family's finances tremendously in the future. Let's dive in. All right, so what I'm going to do is I'm going to start with a traditional whole life insurance policy. This is a whole life that you would get from a life insurance agent or an advisor, primarily going to be focused around you're providing death benefit for protection. That's all this is. But I wanted to start here because this does not work well for the infinite banking concept. So when we come in here, we're just going to keep things simple. We're using the same example for this one and the specially designed policy that we build for infinite banking. And I'm just using a premium of $10,155. Where did that premium come from? Well, if you bought a regular whole life on a 36-year-old male and you wanted $846,250 in death benefit, that's what it would be. We don't need to get into the semantics of that, but what I really want to point out here is that for the $10,155 you put in premium, what you're going to get is a death benefit of $8,446,250. But look at this. Cash value is 0 in the first year. Cash value growth is 0 in the first year. Cumulative return is negative 100%. Cash on cash return, negative 100%. So effectively, you put $10,155 in and your costs were 100%. Now that doesn't sound great, but it isn't bad because you got a big death benefit. The specially designed policy will not have that much death benefit. But what I want to preface is as we go on, the second year, you do the same premium. And again, year 2, you have 0 cash value. So now you've put in $10,155 for 2 years. So you got $20,310 out. You've got a death benefit of $846,250, but nothing to show for it. This is what most of the gurus are telling you is bad about whole life. Oh, the commissions are so high. And the commission on this would be high. It's about 55% of the premium on a regular off-the-shelf whole life. So think about that. That's over $5,000 plus in commission on this policy. Now, when we show you the specially designed, you're going to see a huge difference in commissions. But I just want to point that out. Now, let's kind of move down. Because after the third year, we do start building some cash value. And this is very traditional of whole life. You will, in the long run, get money back. And you know what? For this policy, I just want to come over here, cumulative return. Now, what cumulative return measures is cumulative return measures the total amount we put in versus the amount of cash value we have in the return that's applicable. So how long does it take in a traditional whole life to break even? 16 years. See this right here? In the 17th year, you basically get all your money back for the policy. But it took 17 years. Now your death benefit's gone up to $912,000. You have cash value of roughly $158,000, which is great because you put 162 in, you have 158, and you're just about to turn cumulative positive in the 17th year. So year number 17 in this traditional whole life on a 36-year-old male is when you get all your money back for that. Now, there's some good to that. If you wanted a policy just for death benefit, this would be a good fit. Your cash on cash return didn't turn positive and barely positive until the 8th year. In the 8th year, at 43 years old, this is where when you put $10,155 in, you're going to make more than $10,155. So that's a good metric when we get into the infinite banking concepts, but I'm just trying to show you how inefficient a regular off-the-shelf whole life policy is in this scenario. So in the long run, you're still going to win. You're still going to get all your money back. It just took you a long time to do that. Now, what I want to do is I want to transition from a traditional off-the-shelf whole life, which is what a lot of people, unfortunately, are being sold to be used for infinite banking. Actually, a lot of people are being sold IULs, which would be even worse than this, but let's not go there. I want to keep this very specific. This is traditional whole life. All right, hey, hang on a second. I need your help for something. I've been trying to explain this whole explanation of the infinite banking, but here's what I need. I need you to click that subscribe button right there. And what I'd like you to do is I've been practicing something. There's a little bell. I need you to smash the bell. Ah! Ooh, that was pretty good. I've been practicing my Bruce Lee. Smash that bell so you're notified every time I put out new content. Let's get back into these designs. Now what we're gonna do is we're gonna come over here and we're gonna look at a specially designed and engineered whole life insurance policy that we built for the infinite banking concepts. Exact same scenario. We're looking at a 36-year-old male putting in a premium of $10,155. Now, when we design and engineer these, I want to be clear, you could put any dollar amount you want in premium deposits. It doesn't matter. I just want to keep things level. Now, see the big difference here? Look at the death benefit. The death benefit is significantly reduced. And this is something you have to factor in. But when we build these policies for the infinite banking concept, we are building them, I want to be clear about this, for maximum high early cash value. We are not building them to maximize death benefit. The death benefit in the later years will grow and it will be sufficient. But in the early years, that's the trade-off. We give up death benefit for cash value because we're building a private banking system. So again, 36-year-old male putting $10,155 in, but now in this scenario, we immediately have dividends because we have cash value building up immediately once you make your premium deposit. After the first year and the dividend was paid out, which is one full policy year, 12 months, you have $8,410. But you would have had access to some percentage of this $8,410 immediately in the first 30 days. So immediate liquidity of a portion of your money. And in this case, it's roughly about 82% after the first year. So your loss in the first year was $1,745. You remember in the other policy, it was the full amount. It was the $10,155. Now your loss to expenses, which are cost of insurance, commission, which is the one everybody always talks about, and a policy service fee. Those are the three expenses you have in these policies. This one, the commission was significantly reduced. Literally, the commission on this particular design was reduced over 80%, which is how you have $8,410 in cash value. It's all the design. It's how it's contractually designed. It's a big, big difference. Plus, your cost of insurance, obviously, on $164,000 is significantly less than the traditional, which was, I believe, if we just flip, was $846,000. So you could see $846,000 death benefit on the original traditional whole life, but you gave up 100% of your cash value. Here, we only gave up $1,745 of the $10,155. We got $8,410 after the first year, but a significantly reduced death benefit. Now let's get to the good stuff. Now that you understand the differences in the first year, let's go to the efficiency years. There's a couple things here, and I want to notate them. Right here, this is your dividend. Every year, these insurance companies, because they're mutually owned life insurance companies, they pay a dividend. They've never missed one. The dividend is not guaranteed, but they have never, ever missed one, not since the beginning of these insurance companies' inception, which can be up to 160 plus years old. So right here, what we're showing you is we're showing you that your dividend is $2,044 at that point. Why is that such an important amount? Because if you needed, at this point, the dividend would be just about sufficient to pay the premium. Because here's your real premium, $2,500. That's how much is going to the base portion of the policy. And I'll show that in just a second. There are two pieces to this particular design. There is what's called paid up additions, PUAs. Okay, this is what we're mostly using on this. We'll call it paid up ads, and then there is the base. All right, so now let's just do this. The base is the traditional whole life component. All right, just like you saw before. This policy that we looked at before, this is 100% base. No paid up additions are here. Okay, over here, 2,500 is base, and the remaining amount of 7,655 goes to paid up additions. Now, let me explain something about commissions. Remember before, over here, we did the math, $10,155. Let me just kind of bring a calculator over. If we were just looking at basic commission rates, now they do vary depending on state, but let's just say that it was 55% for commissions. This base policy would have paid a commission of roughly about $5,585 at 55% commission, okay? When we come over here, the commission is paid on the 2,500. So 2,500 times 55 means the commission would have only been $1,375. So 1,300 minus the $5,585, that's $4,210 that goes right to your cash value. Now the paid up additions, we do get paid a commission, but it is roughly about 2%. So times 0.02 right there, 153.10. Now this can vary depending on the company, but I'm just keeping this simple. So the total commission on this policy is $1,528.10. Okay, this is the specially designed and engineered one. And remember, the commission over here on the base was $5,585. So you can see the difference here. It's a significant reduction in commission. Now, because of the significant reduction in commission, because the way the policy is designed to maximize cash value and immediate access to your money, what we're also going to see is now we're going to see some efficiencies. Right here, it takes 3 years in this policy with no dump in to hit your cash on cash efficiency point. So you can see the first year, you lost 17%, which was that $1,745. The second year, you lost 5.7%, which is $576. I want you to think about this. Look at this death benefit, $164, not a lot. The next year, $185. The next year, $206,000. See how fast that death benefit's climbing? That's because of the way it's designed. It's designed to have your death benefit go up over time, but your cash value to be the main priority here. Imagine paying $576 in 1 year for a $185,000 policy that never ends. That is the cheapest life insurance I think you'd ever find for a 36-year-old. Even at $1,745, if we were to compare this to term insurance, that would probably not be a terrible rate. But here, by the third year, your net cash growth is negative $46, which means that year, your net, all in, cost you $46 to insure yourself for $206,000 in death benefit. And by the third year, you turn cash on cash positive. You made 5% on your $10,155 in the third year. Here's the numbers, folks. Cash on cash return, you made 5.10%. You made $514. You have a death benefit of $227, which has climbed from $164. See how this is starting to really be amazing? But here's the other thing that's really cool. Every year for the rest of your life, that number goes up. It can't do anything else. Next year, you'll have more than you did this year. The next year after that, you'll have even more than you did the year before. It's amazing. 5.1, 11.2, 17%, 24%. Folks, these aren't made up numbers. This is your cash on cash return on new dollars going in. So by the fifth year, you put $10,155 in. We'll just go right here to the fifth year because it's important because that's the year your dividend is sufficient to make your base premium. You put $10,155 in. You get $11,294. For the $10,155 you put in, you could take out or use $11,294. That means it's an 11.2% return on your new deposit of $10,155. But hold on, this year right here, see this? This is your cumulative return. Let's go back to the base policy. The normal one took you 16 stinking years. Good, bad, or indifferent, took you 16 years to break even on the policy. It's still better than term. But over here, what did it take you? It took you 6 years to completely break even on your policy from a cumulative standpoint. In other words, you never take any loans, you never use the money, you just put it in there. 6 years later, your policy is bought and paid for. It is literally printing money. So you made 1.8%, which is better than most bank accounts over 6 years cumulatively, then 5, 8.5, 13. Look at these returns. Okay, we get down to the 17th year, your cumulative return is 54.7% on the money you put in. In other words, you put 103,636 in, you have cash value of 160,281. That would represent a 54.7% cumulative return. And right here, your cash on cash return, because you put 2,500 in and you could take 9,639 out that year, that's a 285+ % cash on cash return. Now listen, we could dissect these numbers any which way, but I'm just trying to make the point. There is a massive difference between a traditional whole life insurance policy that most agents and advisors sell and the specially designed and engineered policies that we use for the infinite banking concept. Now, the give was you gave up death benefit. But let's just come down here. Let's say this 36-year-old gets to be age 75, all the way down here. This is especially designed. You have a death benefit of $680,000, which climbed from $164,770. Now, I know Dave Ramsey says you don't keep your cash value in the policy, but the cash value forces the death benefit up. I want to be clear about that. As your cash value grows every year, the paid up additions increase your death benefit, as you can see here. The other thing I want to point out here, and I want to be very clear, is the policy that we design, which is specially designed and engineered, this one has a run rate. We're going to put $10,155 in the policy for a period of 7 years. Then we're going to reduce it down in the 9th year to the base. You see the 8th year, we drop a little bit, which is the term insurance dropping. You can see that right here. We had a small term rider, so we go from $295 to $219. We drop that because we don't need it. And then in the 9th year, we go right to the base, okay, $2,500. Now, a lot of people in the infinite banking space say that's a mistake. But the reason we do that is after that point, we have shown the mathematics around the design. The paid up addition deposits are not as efficient as the base growth. $2,500 goes in the 9th year, and you get $6,557 in growth that year alone. That's that 162% cash on cash return. But all I'm trying to do is explain to you that there is a massive difference in the way we design these policies. I know I went really fast with that. It was a lot of numbers, but I think it's pretty undeniable that the cash value growth is significantly higher in the specially designed, which makes sense. We're teaching you how to be the bank. We're teaching you how to take back your banking functions in your life. So therefore, the cash value, the access and liquidity of your money is far more important in this design than the death benefit. Hey, I hope you've enjoyed this video. It was a short and sweet explanation, but if you want a longer explanation on how to design an IBC policy, check this updated video out right here. That'll give you the full deep dive. We'll see you on the next one.